Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who have subscribed to the channel. Really do appreciate it. We are fast approaching 1,000 subscribers, so if you have not done so, go ahead and hit that subscribe button down below. Join us on this journey to financial freedom. Join the Vested Interest community. On this channel, we cover dividend growth investing. We cover portfolio updates like this one here. We will be looking at the $958 that we added to the portfolio. Any options that we do from week to week, we cover those as well. Any dividends paid out, any stocks we might sell. That is what this video is about. I also do a stock pick of the day series Monday through Thursday where I cover a stock that is pulled back on the day or one that has been suggested by a subscriber or someone in the comment section, to see if it potentially is showing value there, trying to find value in the market. A lot of times whenever stocks are running up, that gets harder to do, but we do that every week. We also cover our dividends paid for the previous month, as well as stocks we will be watching and looking to invest in for the upcoming month. So again, if you are interested in that kind of content, if you are a dividend growth investor, hit that subscribe button down below, hit that notification bell so you're notified whenever we put out any new content, and join the Vested Interest community, building a community of like-minded dividend growth investors so we can share our experiences, stocks that we are watching, stocks we're avoiding, tips and tricks along the way. We can all learn from each other. Drop your comments down below. Let me know what you added to your portfolio this week. I'd love to hear it. With that said, let's jump right in and look what we did with the $958 we added to the portfolio. So we started out July 20, well, this is July 23rd update, no options this week. We did not have any. We have been running the wheel on CVS. CVS ex-dividend date is this week. I believe it was the 20th. So we wanted to pick up those shares before that. So if I would have run out another option on that one, it would have expired Friday, which is actually after the ex-dividend date. So even if we would have been assigned the shares, we would have not gotten the dividend. So we went a little different route, and I will talk through why here in a moment. But on the 17th, we had our first dividend and only dividend of the week roll in, and it came in from Nutrien, ticker NTR, out of the material sector. This is a company out of Canada, so there are some tax implications on this one if you are interested. They sell potash, right? Products that help our farmers around the world grow goods for us to eat. So it's pretty critical. That's part of the reason I jumped into it. Now, again, they paid out $4.05. We do have the drip set on, so we're right back in and bought more shares of Nutrien, 0.06675. Now, what I was saying about CVS, we missed the boat a little bit on this one. Had I bought them, I have well over 100 shares here, and had I bought them just a week earlier, I was running a wheel on this one, but I didn't really watch the ex-dividend date. And the wheel assigned me the shares, but it assigned me the shares on the Friday right after the ex-dividend date. So even though I had 100 shares assigned the week of the ex-dividend date, because they weren't assigned until after the ex-dividend date on that Friday, I did not get the dividend. So you want to watch whenever you are running, if you are running options or something like that, if you want to be assigned to the shares, you have to actually own them. Even though you have an options call written on them, if you don't actually own them, if it's a cash secured put, for example, and you don't actually own the shares, but you're trying to pick them up, you want to basically either buy them outright or own them outright at least a day before the ex-dividend date. So I learned my lesson on this one, and that is part of the reason we didn't make the same mistake with CVS, and we went ahead and picked up the 100 shares, and we will see that here in a minute. Now, this $4.05, like I said, bought 0.06675 more shares of Nutrien, which basically added 14 more cents in passive income over the next year. Not a lot, but I'll take every dime that I can get. Next up, our first dividend, or not dividends, our first new positions added, right? We actually didn't add new positions, but we added more shares to existing positions. I'm showing $452.32 here invested. I know this equals more than that, but we've been counting the CVS 100 shares over the last couple weeks while we've been running this wheel on them, doing put options and covered calls on this one. And actually, I think we just did two cash secured puts because we never were assigned the shares. We were always right above the assigned. So I went ahead and bought the 100 shares with the funds that I had set aside for running that cash secured put so that we would get the dividends that paid out this week. or ex-dividend date they hit this week, they'll pay out sometime in the future. And then with the additional funds, the $452.32, we added 10 shares of AT&T, ticker T. And I know communication sector is really beaten up, and AT&T is a terrible stock, rah, rah, rah. I get that. But listen, I don't look at AT&T for a bunch of growth. I look at AT&T for a high dividend yield. I believe they're relatively safe now that they've cut the dividend and spun off Warner Brothers and a lot of their debt. So I'm looking at this like a high yield savings bond with the potential for some growth. And at $13.59, it's just cheap. And I'm sorry, it just by the metrics, by the numbers, looking at AT&T, even if they were flat or even a little negative, $13.59 makes them a very cheap stock. And the same thing goes for Verizon Communications. Verizon Communications, ticker VZ, both out of the communications sector. 10 more shares there at $31.65, and same thing. Verizon is just too cheap, and it actually has dividend growth. It's slow, just under 2%, but they are growing the dividend. They're growing revenue over time. Again, slow growth, but I'm fine with slow growth whenever I can get a 7+% dividend yield, and I can on both of these, so I'm fine picking those up. I know a lot of people will say that's crazy or they're staying away from them. I completely understand. If you don't want to be buying them, that's fine. I am. I don't mind it. Again, high yielders, even with slow growth, I am fine for that as an income play. And that's what these are. These are an income play for me. I am looking to get out of the workforce sooner than later. So I am looking for some steady income, and these are perfect ones to do that. Plus, I just feel like they're cheap at the $31.65. That's cheap. $13.59 per share. That's cheap, even with slow growth. And then I didn't count the CVS 100 shares, but with the 7,000 to buy those, like I said, I've been counting that the last couple of weeks running that cash secured put. So it's here because we actually did buy them to get buy them and own them before the ex-dividend date to make sure we would get the dividends on the next payout. So out of the $452.32 in the AT&T and Verizon shares, it added $37.20 more in passive income over the next year. And our last buy, forget about this 14th, it was July 18th here. These are the snips actually from my brokerage account. And we finally added back to the utility sector, NextEra Energy. And I just, it seems like I always do this, but I buy and then they jump right back up. So NextEra Energy, we bought 7 shares, ticker NEE, out of the utility sector at $72.36. But I think by the end of the week, they had jumped up to like 75, 76, somewhere in there. We'll see that here in a little bit. So now they're right up against just at their 15% of their 52-week low. So I'm hoping that I can continue to build this out and it stays back down here. But it's just the way it goes. $506.52, and that added $13.09 in more passive income over the next year. And the dividends paid out from Nutrien, the buys from Verizon and AT&T, plus the NextEra Energy shares added all total $50.43 in additional passive income over the next year. So not a lot, but I will, again, take every dime and penny that I can get in passive income, and it will continue to increase this snowball over time. So a quick run through the sector allocations. Communications making up 8.34% of the portfolio. Consumer discretionary, this little bitty slice right here, makes up 0.16. Consumer staples, 5.75% of the portfolio. Energy is sitting at 6.82. Financials, 11.84. Healthcare, the largest sector, and the CVS additions, the Pfizer additions we've been adding recently, and Johnson & Johnson as well. All in, although Johnson & Johnson did run back in the 170s this week, we've been buying it and could have bought it earlier in the week at 157 actually. Didn't buy it this week, but bought it last week at 158. Now it's all of a sudden back up into the 170s. So you want to jump on these whenever they pull back. That's what we're trying to do here. Buy them as cheap as possible. Whenever you see the value there, go ahead and scoop them up. Don't wait, because it doesn't take long before they turn around pretty quick. We'll see that here in the overall portfolio as well. Industrial sitting at 8.47% of the portfolio. Technology at 8.94%. Materials, 15.33%. It is the second largest piece of the pie here. Utilities, finally have some utilities back in. That NextEra Energy purchase at 0.34% of the portfolio. And REITs and real estate sitting in third place at 14.71% of the portfolio. I do not have any ETFs. I consider my overall portfolio its own ETF. As a matter of fact, I look at a lot of the ETFs and see what their top 20 holdings, 30 holdings are, and I use those as kind of what I go through and see, is there value here? Are these worth adding into my portfolio? If they are in these ETFs and I add them to my portfolio, it's kind of like building my own ETF, right? I just don't have to pay the fees. So that is the idea behind this channel, building out your portfolio. That's why I call it vested interest. You can control your own portfolio. You can do stuff like that. Look at companies, Warren Buffett's 13F, for example, or Ray Dalio's 13F. See what they're investing in. You can see that from quarter to quarter. Now you're a quarter behind them, so you can't buy it exactly the same time. But I'll be honest, I have bought a lot of things that Buffett has bought. Ally, for example, Kraft Heinz, for example, at lower prices than he does. Occidental Petroleum right now, I think you can get cheaper than he bought it. And you can not necessarily time the market, but you can see what they paid for them and try to get them close to what they paid for them. And I'm just going to tell you, if Warren Buffett has been one of the greatest investors for decades and decades, I don't mind copying him a little bit. My portfolio is not exactly the same, but I do have some of the same stocks that he holds. And like I said, I do have some of the same stocks he holds at cheaper cost basis. Now you can look at this part over here and see the sector weights a little different way. It is kind of interesting to look at this. You can see the percentages here, just like you can see the percentages here, but you can also see the cash value associated with it. For example, let's look at the top three, right? Healthcare is not only 19.3% of the portfolio, but I also have $30,152 into that position. All right, second up is, looks like 23 materials, 23,941, and REITs and real estate at 22,000. So those three positions all over 20,000. Everything else is under, right? So that tells me maybe I need to pare back a little bit on the overweighted and look at some of the underweighted sectors. Now, what you're all interested in, or at least most of you, the weekly portfolio update. Here's the ticker right here, all the positions in the portfolio, how many total shares I have, the current price as of the close of business on Friday, the current market value, again, as of the close of business on Friday, my average cost per share right here, my average purchase price right here, total return, whether I'm up or down. I'm going to show it every week, by each position here. If it's in the red, it's down. Percent return, just a little bit different way to look at total return. Here's the percent return. Again, if it's in the red, it's down. What sector the company falls in, whether it's a quarterly, monthly, semi-annual payer. The current yield, the yield on cost, my yield on cost, the portfolio weighting. So on the previous slide, what we saw was the sector weighting. This is by position. So Ally makes up 3.91% of the portfolio, Bank of America 7.93, for example. So I don't like any one position really to get over 10%. I know Johnson & Johnson is close, right? But same thing. I need to maybe pare back a little bit on that one and look to add to some other spots there. Estimated annual income in this tab, payout months, dividend growth, and where the company sits 15% of its 52-week low. So what that basically means is, let's talk through that for a minute. So CVS, for example, where is CVS? CVS here, right? We had 10 shares. We bought the 100. We were doing the wheel on them, right? We've been counting these for a couple weeks. Our cost basis is $70.69. Let's go over here to where it's at. 15% of its 52-week low is $76.29. So I am comfortable buying CVS as long as it is under $76.20, or my cost basis. Really, I start with my cost basis. Is it under my cost basis? No, it's not under my cost basis. It's at $75.08. But is it still under 15% of its 52-week low? Yes, it is. So this one would still be a buy. But mostly, I focus on the ones that are in the red to show me where I'm going to buy. Like next week, right? Verizon, still down 20%. AT&T, still down 16.8%. At Stabany-Stillwater, down 21%. Pfizer, down. Kraft Heinz, down. Enbridge, down. Bank of America. So I am in the red on those. So I'll probably focus on these ones first. And to be honest with you, I'll probably focus on Enbridge, Kraft Heinz, and Pfizer the most over the next couple weeks to try to catch them while they are down. And the only reason I say that, I know Bank of America is below my cost basis, right, at $31.98, but it is above 15% of its 52-week low. So really that one, I'll add to it sparingly, but at 387 shares, not a ton. And this one's been creeping up lately, so I'm assuming this one's going to flip. Actually, a lot of my positions have flipped over this last week. I had a lot more red last week. Let's run through the totals down here. Total shares, 4,332.675 shares. Current market value, $156,195.85. I have $152,813.88 into it. The portfolio is in the green again, up $3,381.97, or up 2.21%. Current yield 4.723%. My yield on cost 4.827. But really, this is what it's all about. I don't care if the portfolio is up or down or the market's floating sideways. This annual income is really what I'm focused on, $7,376.44. Very nice to see this continue to grow week after week, month after month, year after year. Now, dividend growth right now, if I was to stop the portfolio on average based on and I really need to have my wife help me here and show me how to do this weighting, because this average is not weighted by the position weights. It is just based on the average. But the average growth on this one, 8.08% would be the CAGR here. So let me know what you think down in the comments section below. Drop a like, share with anyone you think you might find value in the content. Go ahead and hit that subscribe button down below. Join us on this journey to financial freedom. What did you add to your portfolio this week? What dividends were paid out? Do you do options? I'd love to hear from you. Drop a comment down below and let me know what you think of the overall portfolio. That is it for this one. Hope you're having a great week. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors so we can share our experiences, share stocks we're watching, share our portfolios. Again, tips and tricks that we've learned over the past. You can learn something from someone else. We all have something to offer. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. If you have something you'd like me to cover in the Stock Pick of the Day series, for example, go ahead and drop it down below and I'll try to work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.